Today we are going to see about overview of international taxation and DTAAS. Today we will see about the introduction to the every part. The coming days we will see in depth in everything. Let's see. What is international taxation? Anyone can say.
Taxation of assessee more than in a country other than the domestic country, which is known as international taxation.
International taxation is the taxation of income of a taxpayer who is resident in one country from transaction carried out in or with of from another country. That is, assessee is one country and the transaction has made with another country. It involves two different countries. International taxation involves study of domestic tax provision is so far as they apply to non-resident and the provision of tax treaties. Section 4 is the charging section of income tax. Total income is defined under section 245. Person is defined under 231. Previous year is defined under section 3. Assessment year is defined under section 29. Tax is defined under 243. Scope of total income depends upon the residential status of a person is defined under section 5. Definition of residence in India for the purpose of the act is defined under section 6. The scope of total income. If income accrue or arise or deemed to arise in India, for a resident it is taxable. For a resident, for a resident and ordinary resident it is taxable in India. For a resident but not ordinary resident also taxable in India. For a non-resident also it is taxable. If income is received or deemed to be received in India, for all the 3% it is taxable. In case of income accrue or arise or deemed to accrue or arise outside India, for a resident and ordinary resident it is taxable. For a resident but not ordinary resident and also for a non-resident it is not taxable. Income deemed to accrue or arise in India, section 9, which says the following income shall be deemed to accrue or arise in India, covers income arising directly or indirectly through or from business connection. That is, the income is derived through some business connection in India. Significant economic presence, which means particular income from goods or service or from download of data or software. If it's earned, it is significant economic presence. This have a threshold limit. The amounts 20 million, that is 2 crore. The amount should be 2 crore, or the participants number of participants. The foreign entity connected with India should be 3 lakh or more. That is significant economic presence. Or the income should be earned through a property in India, or asset or source of income in India, or transfer of capital assets situated in India. If a salary, if it is earned in India, it is taxable. It covers income by way of dividend paid by Indian company outside India, covers income by way of interest, royalty, fee for techniques, everything comes under income deemed to accrue in India, and it is taxable. What is tax treaty? Yesterday itself we saw a tax treaty is an international agreement. Normally it's a written form, passing various titles. It's like it's a written agreement between two countries to avoid double taxation. Section 19 says if in the domestic law says have one tax rate, and the DTAA has a lower tax rate, the assessee can claim that lower tax rate. That is section 9. If section 91 says relief from double taxation, there is no tax treaty with a particular country, a person resident in India, if no tax treaty is there, a person resident in India is allowed for the foreign tax paid against the amount in Indian for the amount of Indian tax. Person resident in India is allowed credit of foreign tax paid against amount of Indian taxes. That is, if there is no tax treaty DTAAs, a person can claim the benefit under Section 91. GAR. GAR is an general anti-avoidance rule. It's impossible avoidance agreement. A person cannot enter into an agreement to evade tax. The applicability is the main purpose is tax benefit and satisfaction of secondary test. This have a threshold of if it exceeds 3 crore, the general anti-avoidance rule is applicable. There are 3 model of tax treaties: OECD model, UN model, US model. OECD model is entered between a developed nation with comparable tax system and objectives. UN model is entered into between developing or less developed nations. US as a model convention on commentary to form basis for its treaty with other countries. There are 4 type of tax treaties. Limited treaties means the source of income is with 1 or 2 source. That is, India, Pakistan have a treaty with respect to air transport. India, Saudi Arabia has a tax treaty with respect to air transport alone. Comprehensive treaty means the source of income will be more than 2, multiple. Multilateral versus bilateral treaties. Bilateral is the treaty between only 2 countries. Multilateral is between several countries. Tax information exchange system is also a type of treaty where this does not involve any rates. This just information transferred from one country to another. How a tax treaty is being formed? Basically, it's negotiation. Basically, it starts with negotiation, then drafting of the article. After that, it will be signed between 2 countries. Then it will be ratified by both the countries. Then notification will be issued. Then the tax treaty will be coming into effect. This is how a tax treaty being formed. What is the purpose of tax treaties? The objective of entering into tax treaty: to avoid double taxation, preventing of tax evasion, exchange of information and mutual assistance between taxing jurisdictions, encouragement of mutual trade and investment. Preamble of multilateral convention. This is the action point 15 of BEPS, intending to eliminate double taxation with respect to tax covered by this agreement without creating opportunity for non-taxation or reduced taxation through tax evasion or avoidance. Under BEPS, purpose of tax treaty is both to eliminate double taxation and prevent double non-taxation. This illustration with respect to double taxation. A foreign company rendering technical service to Indian company from outside India. Fee is paid by the Indian company to a foreign company. These fees will be taxable in India even if the service are rendered outside India. India would subject the fee to a gross basis of 10% plus surcharge and cess, which the income is deemed to accrue or arise in India. Foreign jurisdiction would further subject to income tax on net basis as foreign company would be resident in that country. This leads to double taxation. This is the example of double taxation. There are 2 types of double taxation: juridical double taxation, economical double taxation. Juridical double taxation is 2 or more states levy tax on the same entity on same income for identical period. Economic double taxation is the same economic stream of income being taxed in 2 or more states but in the hand of different taxpayer. This economic double taxation is Indian company earns business income in India. Indian company pay dividend to foreign company out of its profit. Such dividend is also taxable in India. Actually, presently dividend distribution tax is not there. Previously, if an Indian company have to pay dividend distribution tax, in the hands of foreign company, it has to pay tax there. Juridical double taxation is a foreign company has a branch in India. Income from branch form parts of its global income. So income of branch is also taxable in India. Taxation is source based and residence based. Source based is the host country is the country of source. That's source based and resident based. Resident based is the home country. Source based is the country where it works. The article of the tax treaty is being divided into five: the scope of provision, definition provision, miscellaneous provision, elimination of double taxation, anti-avoidance. These are Indian tax treaties. These are India. Article 1 is this tax treaty is between India and USA. It just shows how we have to read a tax treaty. Okay. Fact of this case: Mr. A is a tax resident in Sweden, is a citizen in UK, employer in US company, but he works in India. He receives salary by a Netherlands company. Which tax treaty we should see?
Answer. The source country. Source country. No?
That's this country.
Sweden is a tax resident.
Yeah. We should see India, Sweden tax treaties only. Significant concept under treaties. Most favored nation clauses. There will be a tax treaty in general with respect to one rate. If both countries have entered into a transaction, enter into an agreement, they can charge a rate which is lesser than that rate. Colombia has become for most favored nation clause. The country should be a OECD member. Colombia has become OECD member on 28th April 2020, and accordingly, with effect from the said date, 10% rate of dividend may be reduced to 5%, subject to satisfaction of beneficial ownership condition as per India-Colombia Treaty. There is a recent circular regarding to the most favored nation clause. The circular provides that the benefit of lower rate or restricted scope under most favored nation clause will be extended only when all the below conditions are satisfied cumulatively. India's DTAA with the country which has beneficial lower rate or restricted scope is entered into after signature entry into force depending upon language of most favored nation clause. The third state has to be an OECD member at the time of signing its treaty with India. India limits its taxing right in relation to the rate or scope of taxation in its treaty. India issued a separate notification under the Act for imposing the favorable benefit of the third state treaty into an original treaty. If the country satisfies all the four cumulative conditions, they can have most favored nation clause. Okay. BPS, base erosion and profit shifting. These are introduced to avoid tax evasion by transferring the profit to a country where there is less tax or there is no tax. BEPS has 15 action plans. The 15 action plans have been divided into three: coherence, substance, transparency. In coherence, hybrid mismatch arrangement, controlled foreign company, interest deduction, harmful tax practices. In substance, preventing tax treaty abuse, avoidance of permanent establishment status, transfer pricing, uh, transfer pricing, risk and capital, high risk. In transparency, methodologies and data analysis, disclosure rule, TP documentation, dispute resolution. And MLA is a multinational instrument, is a treaty or standard template which is designed to help implement the recommended measure to avoid tax treaty abuse. Countries will be able to use MLA framework to implement some of the BPS action plans relating to double tax treaties. In the coming session, we have a session regarding to MLA. So this is just an introduction. Recent update in digital economy. The BPS 2.0 has two pillars. The pillar 1 focuses on the rules for taxing profit and rights with a formula to calculate the proportion of earning taxable income within each relevant jurisdiction, that is demand side and supply side. Pillar 2 is yet to come. It says global minimum tax of living 15% to discourage the company from shifting profit to lower tax countries through international trading structure.
Yeah.